Hello, welcome everyone. Happy Tuesday, happy May. Going to apologize in advance. My allergies are going crazy, so apologies for the sniffles. Thank you all for taking some time today and joining us for What Your Financial Statements Are Telling You and How to Listen, presented by Corporate Finance Brief and sponsored by Bill. I'm Tara, the webinar manager of Corporate Finance Brief, and I am very excited to bring you this new session that is going to help you decode your numbers and turn financial data into a strategic advantage. I'm really looking forward to hearing from David Worrell today and what I'm sure is going to be a valuable discussion. And just so you know, we will be recording this session in case you need to leave early. It will be sent to you by email within 48 hours. And you can also visit the webinar registration page to access the recording later on. We're going to send that link across in the chat now so you can bookmark it for later. Up next. Before we go any further, I just want to thank Bill for sponsoring this webinar and helping us to make this happen. Bill is a leading financial operations platform for startups to established brands. Headquartered in San Jose, California, they're a trusted partner of leading U.S. financial institutions, accounting firms, and accounting software providers. They empower business owners, CFOs, controllers, and accountants to save time and take control of their payables, receivables, spend, and expense management. And for more information, you can visit bill.com. So thank you again to Bill. Up next, let's quickly get some technical things out of the way. Please don't hesitate to ask your questions during today's event. You can do so by submitting your questions into the Q&A panel, which is found in the toolbar at the bottom of this window. Great questions contribute to a great discussion. So stick around. We'll have some time, some breaks in between, and some dedicated time at the end where we'll get even more insights and advice from David. The chat is also available for you to share your thoughts and comments there. Remember to change the blue button in the chat box to everyone so you can join the conversation. And feel free to use the React feature it found in the toolbar as well to react to any part of today's presentation that really resonates with you. My wonderful colleague Tori will be fielding your questions today, and she will be happy to help you with anything technical that comes up as well. So feel free to pull up the chat, say hello, let us know where you're all joining from today. Closed captioning is also available for this webinar, and to enable this feature, you can select the show captions option from the toolbar at the bottom of this window. And lastly, if you have any audio issues during today's presentation, you can always choose to dial in by phone. All of that dial-in information can be found in your webinar confirmation email that you received from Zoom. Tori can also relay it to you in the chat at any point if you need it. Up next. Again, today I'm so excited to hear from David Worrell, an accomplished CFO, serial entrepreneur, and author. David is the founder of Charlotte-based Fuse CFO. David and his team at Fuse CFO provide a complete outsourced finance and accounting department for small and medium-sized businesses. His clients include film producers, online retailers, manufacturers, healthcare companies, and private equity funds around the country. David also taught international business planning within the top 10 ranked MBA program at Fisher Graduate School of International Business in Monterey, California. He also wrote a widely used textbook, The Entrepreneur's Guide to Financial Statements, and more than 300 other published works on entrepreneurship and finance. David, without further ado, I am going to turn it over to you.
Thank you, Tara, and thanks to Bill, or formerly Bill.com. I'm probably not supposed to say that, but I have a long relationship with Bill.com, actually. And you mentioned my book. The founder of Bill.com actually wrote one of the intros to my book. So we go way back. And I like Bill, and I appreciate your support today. So forget everything on this slide about me. You don't really need to know that. What you need to know is that I have one superpower, and that is reading financial statements and telling stories to management teams about their company based on the financial statements. And that's what I want to do today with you guys is learn what financial statements are telling you and how to listen to them so that you can then start and present a story to the management team to help them improve their company. So I think we all have a similar problem here. Now, let me set the stage. I'm going to assume that you guys know something about financial statements. You understand that there's a profit and loss statement and a balance sheet, maybe even a cash flow statement. We're going to talk about them today. We're going to do some basics, but I'm going to assume that you know your way around them a little bit. If that's not the case, you're welcome to email me directly after the show and we can catch up on whatever you need. But I think we all anyone who works in a company and has any exposure to the financial statements has a similar problem. How do you know that the books that you're looking at, the accounting records, are true? And if they are true, what are they telling us? And finally, how do you help managers make decisions based on that? The solution is, of course, to be able to recognize common mistakes in your financial statements, and then to do the really hard work of turning numbers into words to tell a story, right? Lots of financial statements are just long lists of numbers. If you can't turn those numbers into words, you're going to have a hard time communicating them to people who are not financially astute or financial analysts. And one way to do that is to use a dashboard and ratios, which we're going to talk a little bit about, but using a dashboard to simplify the communication to a non-financial manager. How do you get there? Well, so first, as the translators of financial information, you and I need to understand the financial statement basics. We need to be able to evaluate the books to know whether they're correct or not and look for some warning signs. We need to be able to explain them. And finally, we need to be able to drive dashboards that help us act and make better decisions in the business. And those are the four things that we're going to really focus on today is understanding, evaluating, explaining, and finally getting to a dashboard that helps you act. So let's dive right in and begin with a balance sheet. And I just have to do a little more basic review because so many people are scared of the balance sheet. And I hope after today, you won't be scared of a balance sheet anymore. I have great stories about entrepreneurs who just ignore their balance sheet. And when I ask them to show it to me, they say, I don't even have one. And I know, and I hope you know that that's just not true. Every business has a balance sheet. And we're told that a balance sheet is called a balance sheet because the assets balance with the liabilities and equity. Throw all that out. Forget all that. That's accounting junk. You don't need to know that. I'm going to give you a much easier way to understand what a balance sheet is. First of all, you need to remind yourself that a balance sheet is your net worth. It talks about how much money is in each account. What's the balance of each account in your business? So your business has a checking account. Maybe it has a credit card account. Maybe it has a loan account with the bank. You've got a car loan or a savings account or whatever it might be. All of those accounts have balances. And the balance sheet is just a list of all the accounts and their balances. So forget all this stuff about equity and liabilities and assets. It's important that you understand a balance sheet shows the balance in your accounts. Now, because it's showing you how much is in each account, it measures wealth and not income, right? What are you worth today on a specific day? If I ask you what's the balance in your home, your home checking account, you would ask me, well, do you want to know on the last day of the month after I've gotten paid, or on the first day of the month after my mortgage expense went out of my checking account, right? So the balance sheet measures your wealth on a specific date. All right, if you've got that down intuitively, now I'm going to go backwards for a second and I'm going to tell you it is true that a balance sheet balances. And the easy way to think about that is that what you have has to equal how you paid for it. When you go buy a car, you can buy a car by putting a down payment of cash and by borrowing against the car. And when you add those two things together, the cash that you paid to the car dealer plus the amount that you borrowed, guess what? You get the full price of the car, right? You don't borrow any more than you need and you don't pay any less than the price of the car. So those two things equal themselves. The asset, what you have, equals how you paid for it. And we know that there's two ways to pay for things, cash or debt, equity or liability, if you want the accountant's word for it. But when you see some other balance sheet, so remember, we're here to interpret balance sheets. When you see a balance sheet, I want you to ask three questions. What does this tell me that the company has? How did they pay for it? And really importantly, this is a huge tip, is it changing over time? Does your home checking account change balance over time? Heck yeah, right? Some days it's great, some days maybe not so great. So you expect to see the balance sheet changing over time. To do that, you've got to put two periods together. You got to look at two balance sheets. Because remember, each balance sheet represents one moment in time. All right, I'm going to show you the real thing, baby. You ready? We're going to jump in and look at a real balance sheet. Now, I happen to know this is from an e-commerce company, but let's pretend that I didn't know that. I'm looking at just the top of the balance sheet, the part called the asset section. And this answers the questions, what do they have? So let's just start there. What does this company have? Well, it has a checking account and a savings account, which you'd expect, but it also has a PayPal account. PayPal. Now I'm thinking about this. Remember, we're trying to tell a story. We're trying to know what kind of a company it is. So I'm looking at this going, PayPal means they probably sell stuff to consumers, right? What else do they have? They have inventory as an asset. Wow, very cool. Okay, now I know that they own products that they probably sell to consumers. And what else? Down below, as a fixed asset, they've invested a lot into their website development. Ah, ding, ding, ding. This is not a grocery store that happens to have a lot of inventory. This is an online website seller that's selling inventory to consumers and using PayPal to get paid for it. Well, I already know a lot about this company, and you didn't have to tell me anything. So now let's do the hard part. Let's look at the numbers and see what the numbers tell us about the company. Well, the numbers, first of all, two columns because we are comparing balance sheets, in this case from November to January. It's at least 2 months apart. It doesn't really matter which two periods you pick, as long as you pick two periods that are far enough apart where things should have changed a little bit. All right, what do I see? Number one, in November, right at the top, let's talk about cash. In November, their total bank account cash was $507,000. It's now under 400, so they're using a little bit of cash. What else do I see? Well, let's take a look here. Oh, PayPal clearing account stayed exactly the same. Does that mean that they no longer sell to consumers? Maybe this whole PayPal thing is an old effort that they're not using anymore. Or maybe the accountant, the bookkeeper, has just not gotten around to fixing it. Now, I picked November and January because that's across a year, a calendar year, right? That's 2024 to 2025. These things should be up to date when you cross a year marker because you've got to file taxes and they should be accurate. So here's my first warning flag that says something might be wrong with this balance sheet. The PayPal account is not changing. Even more, the inventory asset is not changing, right? We've said they're an e-commerce company, they've got a warehouse full of inventory, but it's not going up or down. So there's something wrong with this company's books. Either they've gotten into an entirely different line of business, maybe they've been shut down for COVID for 2 months, maybe their bookkeeper's not on the ball and doing their job to keep track of inventory. I've even seen situations where the bookkeeper thinks they're doing a job for inventory, but QuickBooks is set up wrong. And all of my clients use QuickBooks. That's just my world. So I'm going to say QuickBooks. You can substitute NetSuite or whatever. But anyway, the bookkeeper thinks they're doing the right thing, but the inventory is being handled incorrectly by the software. QuickBooks was doing it wrong internally because a long time ago they set it up wrong. So just a red flag to bring your attention to inventory. And finally, accumulated depreciation down below. I'm going to assume you know what depreciation is. Even if you don't, I'm going to tell you, it should have changed over the course of a calendar year. At the end of a calendar year, most tax accountants will record depreciation. And in this case, nothing changed over a calendar year. So you're starting to see some red flags. You're starting to see some things that didn't change. Ooh, and one more big red flag. Did you notice at the very top? The Bank of America checking account shows overdrawn on January 31st, negative, that big red number, negative 32,395. So that's something to be concerned about. Hey, let's stop and tell the story for a second. Answer the question, what do these guys have? We already know that this is a complex, that the company owns a complex website, that they have a warehouse and inventory, and not really very much else. There were some computers, some laptops listed on there as assets, but they don't have very much else. They don't have trucks or cars or buildings. They don't own real estate in multiple locations. So a pretty simple e-commerce company is what this looks like. So, and I'm going to guess based on the value of their inventory that they're probably selling expensive stuff and not just a lot of little tiny parts, right? They're not selling $5 screws or nails. They're selling some big expensive part based on the value of inventory. However, because I've also looked at these comparative numbers, I can tell that recently the company has given customers a lot more credit. That credit is AR, and I didn't point it out directly, but I know on the balance sheet under assets they have AR. That's the amount of money that their customers owe them, and that comes from the invoices they've been writing. So they've been writing a lot more invoices, and the balance that their customer owes them has gone up. I know that they're not accounting for inventory correctly. I think that they're burning cash because we saw their cash balance go from 500 down to $400,000. We might be overdrawn at the bank because we saw that Bank of America balance go negative. And we know that they failed to record the year-end depreciation that we'd expected. So we're already starting to tell this very interesting story about this company that we otherwise don't know anything about. Let's go on to the second half of the balance sheet. This is the liabilities and equity. This is how did they pay for all those things that they bought, right? They bought a warehouse full of inventory. They bought a website. They have cash in the bank. Where did it all come from? This part of the balance sheet, the bottom half, explains how did they pay for all those things that they have. So does it look right? Well, let's see. They have a couple of credit cards. They have deferred revenue, and they have something called a long-term liability to National Business Credit. I'm going to just explain each of these really quickly. The deferred revenue means that customers have given them deposits before the company has shipped the product to the customer. So the company is holding a deposit, which means we really want to send this product to the customer so that we can call that a sale, but we haven't shipped it yet. So we're just going to hold on to their money because we might have to give it back to them, or anyway, we haven't earned the money by shipping the product. And if we know that they have deferred revenue, now I'm scratching my head a little bit because that's not something you would typically see with a consumer e-commerce company. That doesn't fit with my PayPal clearing account idea. Maybe they also have some wholesale business because they're actually writing invoices and sending those to customers. So maybe they have a wholesale business. And then National Business Capital, happen to know that those guys do merchant cash advances. That's a high interest rate, short term, maybe a medium term loan, but it's a non-bank lender. So these guys are actually reaching out to non-traditional, non-bank lenders to get capital. Again, maybe a little bit of a warning flag, but certainly a bell going off in my head saying these guys are hard up for cash to run their business. I wonder whether that's a cash flow issue or what. So let's take a look at the actual numbers, and we see that on the Spark One Capital account, they're actually they actually haven't kept that up, right? Their balances on some of these accounts are exactly the same. We see that their accounts payable has actually gone up. So the amount of money that they owe to their vendors for normal things like inventory or packing materials, maybe they've received the goods, but they haven't paid for them. So went from $350,000 to $500,000. That's a 50% increase. That's a big increase in accounts payable and might mean that the company's having a hard time finding the cash to pay their vendors for the things that they need. Let's see what else. National Business Credit, $12,000. Not a very big loan. That's great. But it's also not moving. It's not being paid down. And I would want to ask questions about that. The Yale Pallet Jack. Let's look at that for a second. This is under long-term liabilities, and that means loans. So they borrowed money to buy a forklift. That's 2,800. That's the account number 2,800. They borrowed money. In 2010, they borrowed money to buy a pallet jack. Except look at this number. It's changing. That's interesting, but it's a negative loan balance. Well, a negative liability is actually an asset. So what this says is the Yale loan for the pallet jack is overpaid by $2,761. I'll tell you what, this is the most common accounting mistake I've see in all of my work is that someone who's recording payments to a loan records the whole amount as a payment rather than counting for interest or otherwise screws it up so that the loan balance actually goes negative. There's no such thing as a negative loan balance, just like there should be no such thing as a negative bank account balance. All numbers on a balance sheet should be positive. In this case, this just tells me that they're recording that number wrong, or they've lost track of their payments to Yale for the pallet jack. So it's kind of interesting. Last thing I want to look at down below in equity is owner distribution and retained earnings. Retained earnings, $3.7 million this year. That's great. Retained earnings is prior year's profits. All of the profits from the prior years of this business since they started up till today. And that's $3.7 million. That's really cool. They made a lot of money at some point, but then let's look at net income, which is this year's profit. And you see that it's $65,000 after 1 month. Maybe that's okay. But what about November? Remember, the column on the right is November from last year. At the end of last year, they were $235,000 in the red, a loss of $235,000. So their retained earnings went down from 399 to 3.9 to $3.7 million. So historically profitable, but recently they've been operating at a loss. And then finally, this owner distribution, I circled that because you notice that it hasn't changed. That means the owner's not taking any money. And particularly at year end, that's kind of surprising. The owner should be getting paid and should be withdrawing profits if it's a healthy company. This tells me that the owner is not getting paid, and maybe that's because the company's not so profitable. So let's tell the story about how did they pay for it. We know that the company uses a lot of credit to pay for things. They have a history of profits, but not recently, and they have multiple credit cards that they're continuing to run up the balance on. Recently, they may not be paying their owners. We'd want to find out whether the owner maybe is taking a big payroll income, but it doesn't look like they're taking a distribution. We think they're falling behind in their payments to their vendors. That was a big liability, right? Accounts payable. And they're not converting their customer deposits to sales. So we saw where they have these uh, uh, deferred revenue or unearned income, and we saw that it's not changing. And so they're not apparently converting those deposits and actually shipping products to people so that they could realize it as sales. Now, maybe all of this is due to the fact that they're just not keeping up with their basic accounting. Maybe it has to do with the fact that the company is failing. We've got to be sure which one of those things it is, but we know that there are some accounting issues in here, and that would be the first thing that we'd want to drill down onto. All right, we've looked at the balance sheet. We know this is an e-commerce company. We think they have both retail to consumers and wholesale. They have tons of inventory, over $2 million worth of inventory, and not such great accounting records. So they have too many liabilities, too much credit on their credit cards and their AP, and they're recently not profitable. We're starting to paint a pretty sad picture of this company, right? Well, before you draw too many conclusions, let's take that story and compare it to facts. So this is my one disclaimer slide. You can read all you want into the balance sheet, but if you don't ask the right questions, you might just be making things up. So if there's an increase in debt, did we see an increase in debt? Oh yeah, right? They took the credit cards, they took the non-bank loan. Well, how are they using that? Is it a cash flow crisis? Or are they simply using it for expansion? So you could look at other things like assets. Are they buying really expensive assets? Maybe they went out and bought their building. We saw inventory appear to be stagnant, and sometimes you'll see inventory building up. Is that because they're collecting inventory for a future big opportunity, or is it that they're collecting inventory, which is just a bunch of old junk, right? If they're not rotating their inventory, they're not blowing out at a fire sale, they're obsolete inventory. Inventory can build up. Inventory could also build up because of QuickBooks problems. If you aren't setting up QuickBooks correctly, it can show all kinds of crazy things in inventory. It's the number one area for QuickBooks problems is inventory valuation. Okay, this company does not have what we call decreasing assets, but let's say that within their assets, they showed that they had just sold off a building or a bunch of trucks or some machinery in their back office. Well, you might ask, why are they doing that? Again, is the business shrinking? Is it a crisis? Or are they simply outsourcing? How are they getting that work done? And finally, the idea of no owner pay. We saw that the owner's not taking a distribution. Maybe the owner's making a strategic decision to leave cash in the company in order to buy growth, right? A company needs cash in order to grow. So is he growing, or does he actually have cash flow problems? All right, that's balance sheet. I'm going to review really quickly the 5 big balance sheet blunders. I love this slide, my little broken ice cream cone slide. So there's 5 things to look for on a balance sheet to decide whether it's broken or not, whether you can get to eat the ice cream or whether you just dropped it on the sidewalk. Number 1, negative balances, right? We saw a negative cash balance in the bank account. We saw a negative balance on a loan, which is just wrong. It's crazy. Number two, inaccurate inventory, big issue, and certainly an issue with this company when the inventory value was not changing. Missing assets and liabilities. So assets and liabilities ought to generally match up. If you have a car and a car loan, both of those things should be on the balance sheet. If you bought a building and you have a mortgage, it should be on the balance sheet. So look for on the balance sheet things that are assets without liabilities or liabilities without assets. Lots of times people forget to put the asset onto the balance sheet when they buy something new like a car. Finally, fake cash or duplicated transactions. I didn't get the opportunity in this one to show you, but there is an account in QuickBooks called undeposited funds. And undeposited funds means you've taken a check or cash from a customer and you've put it in a drawer someplace before it goes to the bank. Look for that. If you see big undeposited funds balance, you know you might have a problem. And finally, commingling personal funds. I hope I don't have to say anything about that, but people who put their personal checking account in there are going to have a real problem telling you much about their business because they've mixed it all up with their business, with their personal side. So let's extract personal accounts from our business accounts and keep them separate, please. Okay, this is a quick note for me to ask Tara if there are any questions about balance sheets. Did I say anything crazy? Did I talk too fast? So Tara, what do you see? Are there any comments that you'd like to pull out?
Yeah, there actually is one that I think is a great question. And this was coming in from Amber. Um, do you recommend providing two dates, numbers over a time period, when providing a balance sheet so that comparisons over time can be examined?
That's exactly right. And you saw in my example slides that we were comparing two periods, right? There's November and January. So excellent point, Amber, that lots of people look at a balance sheet and think that they understand what's going on just by looking at one, but you can learn way more than twice as much by looking at two because you're looking at the change over time. Are assets growing or shrinking? Are the accounts moving in the direction you would expect? Are they moving at all? So absolutely comparative balance sheets is vital. Yeah, really good tip. Thank you.
Perfect. And then we'll take one more question I just saw pop in from Jacqueline. Would there be notable difference in a balance sheet and interpretation for a nonprofit?
Oh, that's an excellent question. Nonprofits have to give their assets away, right? So you will see a very different picture based on how well their fundraising is going versus how active they are at giving their assets away. Some nonprofits start with just a big corpus of money. They start with a foundation or a grant of some kind, and their whole purpose of life is to give it all away. So you would expect to see the assets declining. Maybe they don't even have any future fundraising activities. They're just existing to give this one big pile of money away, and they're going to be done. So yeah, absolutely. I hope that a for-profit company, we actually see assets increasing and we see liabilities staying the same or going down. But nonprofits are going to have a little different story. Still, the point is to verbalize what you see in the numbers and then go back and ask management whether that's a true story or not. So on a nonprofit, you would say, hey, it looks like you're spending down. Did you guys forget to have fundraisers this year, or is that your strategic plan is to never have a fundraiser? So you're just taking those numbers and putting them into words, and then you're bouncing them off the management team to make sure that you're telling a true story.
Thank you.
Yeah, very good. Thank you, Tara. So what's after the balance sheet? Dun, 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 income statement. Okay. I hope this is a little bit easier. You guys know what income statements are. That's where we record sales and the cost of sales and the cost of being in business. So based on what we know about the same company, right? We've already seen their balance sheet. What would you expect the income statement to say? And I always look at the balance sheet first. I try to tell myself that story of balance sheet first so that I can see whether the income statement confirms or denies my expectations. Well, we know that they're e-commerce, they have lots of inventory, they have too much credit, they're not profitable. So we would expect to see maybe declining sales, maybe bad profitability, right? We saw in November that they were not profitable. So let's take a look. What do we see on this income statement? And by the way, income statement is also called profit and loss or P&L. And so I might use either one of those two things. In a not-for-profit It's got even a fourth name, which is escaping me right now. Okay, so income statement. Three things stand out to me here. Number one, wholesale sales. So we thought that they were retail only because of PayPal. Then we saw that they have outstanding invoices in their accounts receivable, and we said, maybe they have wholesale sales. Absolutely, the income statement confirms that for us. And here's something I really like about this income statement. They measure their sales by sales channel: Amazon, retail orders, wholesale sales, and website sales. So man, if I was the CEO of this company, I'd already have a lot of information just from those first four lines. Each month I'm looking at those going, where am I making my money? And should I be emphasizing my website or should I just turn back to Amazon, right? And over the last few years, boy, e-commerce has really changed. People who were selling on Amazon are going blind versus people who can maintain great sales on their website where they make a much higher margin. So in any case, I'm happy to see here that they do have wholesale sales. That explains the customer deposits and the accounts receivable. What else do they have? Gross profit margin, we're going to get to when I uncover this in a second. But then they also have this whole section down here called cost of sales that includes sales commissions and online advertising. I love this. Most people let me put it this way, most income statements that I see go right from income to expenses. And they skip the most important parts, which are cost of goods sold and cost of sales. And cost of goods sold is traditional. You've got to know what you pay for your materials, labor, freight, and in this case, tariffs, right? They added tariffs to the cost of goods sold because every time they bring something in from China, they have to pay a tariff on it. That was a really interesting move I saw. But they've added this section called cost of sales, which is a little bit untraditional. It's not purely textbook, but boy, it sure is smart because what we're trying to capture are variable expenses, right? Cost of goods sold, or COGS, is all the variable expenses. If I sell one more computer mouse, it's going to cost me the materials and labor to make that computer mouse. It might also cost me the sales commission to the sales guy who sold it. And it might cost me, if I'm an online retailer, it might cost me the advertising dollars that it took me to get a consumer to click on the buy button. And that's really important for an e-commerce company is what is your cost of customer acquisition? How much are you spending on online ads and marketing? And so it's a really good example of this idea of cost of sales. Okay. Let's look at the numbers real quick. What do we see here? Man, they're doing great on their website. $800,000 of sales on their website. I love that because you can control your pricing and your margin on a website. They have a tiny amount of refunds and returns. Love that. But look down under cost of goods sold. They sold $873,000 worth of products, which cost them $1.38 million to acquire. They're losing money on every sale, right? $1.3 million, they turned it into 873 just by selling it. So no surprise then that their gross profit margin is negative. And that's where this company has real problems. For whatever reason, they cannot keep their prices up, or they've lost track of their expenses somehow to know what their prices should be. And so therefore they're showing a loss on their cost of goods sold. Now, if we think back a little bit, we also know that they're having problems tracking their inventory. So it may be that they bought some things that they put into inventory and they incorrectly counted them on the income statement, which would increase their expenses for this month and make them go into a loss situation when actually they haven't shipped those products. They're still in inventory. So it may be an accounting problem, but it may also be an operational problem. If you're selling everything you sell at a loss, you're going to have a gross profit margin in the red in here, $640,000 to the negative. Well, no company can come back from that, but it's interesting that in addition to the materials and freight and tariffs, they also paid $122,000 to get those customers and another $50,000 for the sales commission. So these folks have some real issues right from the get-go. Now, of course, there's a second half to the income statement, that is the operating expenses. And the things I want to look for there are Again, we had a question about the owner taking payroll. So I would ask the owner, is your payroll in the payroll expenses since you're not taking a distribution? Maybe there's enough income in there for him to get by. Um, the other thing this company does well is EBITDA. And if you're not familiar with EBITDA, I hope you'll look this up. I could do a whole webinar on EBITDA, earnings before interest, taxes, depreciation, and amortization. So QuickBooks calls it the net operating profit. But you also have to set up your chart of accounts correctly in order to see EBITDA. And that means interest, taxes, depreciation, and amortization need to go below the net operating profit. And we call those other expenses. So you see account number 6,300, interest is that's the I in EBITDA, and it's an other expense. And what that allows us to do is to look at the actual profit from the operations without getting confused about how we financed things. Just the pure turning the crank day to day. Are we making a profit? Of course, we knew that we had a negative gross margin, so we're going to have a negative net margin. But it's a really good practice to pull those things out. So, top 5 P&L blunders. Here's my favorite ice cream cone. Number 1, uncategorized expenses. So you got to know, you got to keep up with your bookkeeping and categorize every expense. QuickBooks will allow you to enter things. In fact, QuickBooks will enter things for you called uncategorized assets and unknown expenses and miscellaneous. All that stuff's got to go away if you're keeping good books. You've got to know what you're buying, what you're selling, and whether you're profitable or not. Missing COGS. Number one problem I see across every P&L is people forget to record what the products actually cost them, and therefore they don't know anything about their gross margin. They think they're making money because the business is profitable at the end of the day, and that's great. But gross margin can tell you so much if you've got to capture the cost of the materials and labor that go into selling whatever it is you're selling. I sell accounting services. I know that my team, my associates who are doing accounting, cost me $75 an hour, right? That's their salary, their benefits, their taxes, all that stuff. I've got this idea that they cost me $75 an hour. I can't go to market and price them at 60. I'll lose money every time. So knowing what your COGS is super important, and a lot of people just skip right over that. Commingled expenses, we talked about that with the balance sheet. So again, anytime you've got personal expenses going in there, you're not telling a story about the business so much as you're telling a story about the business owner, and that's not what we're up for. EBITDA, I think EBITDA is really important and allows you to compare your company to other businesses that are in a similar space, but maybe you're in the software space, for example. You could compare your percentage of EBITDA to Microsoft. What's the Microsoft percentage of EBITDA? Sure, they're billions of dollars and you're hundreds of dollars. That's okay. As long as you've got an EBITDA line that shows what percentage of EBITDA you've got, you could compare it to the best practices in the world. And finally, too much details. I showed you an income statement that took up just 2 easy slides. Things were really boiled down. But I've been presented by entrepreneurs with income statements that are 15 pages long. No kidding, 15 pages. And my first question is, how do you figure anything out? And when you start looking at the detail, you find out that there are 4 categories called insurance, and there are 6 categories called travel expenses, and just unnecessary detail. So too much detail will always hinder you from telling a story and making good decisions. Boil that sucker down. If any account has less than a meaningful amount of money in it, get rid of it. Combine it with something else. A meaningful amount of money, maybe for you it's $100, maybe it's $1,000, maybe it's $10,000. But if you can't make a meaningful decision out of the number that you're presented, get rid of it and roll that account into something else that is more meaningful. So those are the top 5 blunders. And this gives us a chance, again, to stop and ask Tara for some questions about the income statement. What do you think?
Yeah, we have a couple of great questions. The first one, we did kind of touch on, but Alicia is asking, what is the biggest red flag that often hides in plain sight on an income statement? What's the number one thing we should be watching for?
Yeah, number 1 is cost of goods sold. And even those companies that put cost of goods sold as a section on their income statement, and most of them don't, but the ones that do, they will miss things that are actually in there. Let me tell you that actually should be in there, and I'll tell you a quick story. Mobile oil changer. came to me and he said, look, in my cost of goods sold, I pay $5 for a quart of oil and I sell it for 15. I should be getting rich. How come I'm still eating beans and rice? And I said, what else goes into serving your customers? And he says, I just put in oil and filters. And I said, really? What about all the miles that you drive to your customer's location? And he was driving hundreds of miles a day, and he was forgetting that the gas and oil for his car are now variable costs, which are part of his cost of goods sold. So if you have to buy a new set of rags to change the oil, or you have to drive 50 miles to your customer location, or you have to ship the product via FedEx so it can get there overnight, all of those things could be considered cost of goods sold. I even put credit card charges in my cost of goods sold, and some people don't do that, but I like that 3% merchant fee to go right into COGS. So I know whether I'm making money on each individual sale and how much my pricing should be to cover all of that and more. What else, Tara?
Yeah, Carla, I do see your question and I'm going to hold it till the end because
Mhm.
I'm sure David could dive far into that. Um, but I'll touch on Melinda's here. Do you know of any good places, any recommendations to find market gross profit margins for various industries? Any reference?
Yeah, excellent question. So what you're looking for are called statement studies. Now, background is when you go to apply for a loan at a bank, they ask you for your financial statements, and banks collect those statements and they give them anonymously. They take your name off and they give those statements to two companies. One is called Sage, and the other is called the Risk Management Association. And both Sage and RMA publish books called statement studies, and those books will have uh, all of these compiled statements. And so you'll be able to look up by your SIC code, or I've forgotten what it's called now. I'm an old guy, so it's still the SIC code to me. But anyway, your industry code, you can look it up and you can say, hey, for accountants, accounting firms generally have gross margin of 65%. My gross margin is 13%. Maybe I'm doing something wrong here, right? So you can look at those, and those are called statement studies from SAGE, SAGE, or the Risk Management Association, also called RMA. Great question. All right. Anything else you want to add, Tara, or should I go on?
No, let's keep moving right along. We
All
definitely
right.
have great
I got,
questions for the
yeah,
end.
those great questions, and there will be time for more. I got 5 more minutes, and we're going to wrap this up, and you'll have some questions. All right. So to conclude our discussion of balance sheet and income statement, I just want to remind you that if one of them is wrong, the other one is probably also wrong, and you never really know which way it's going to go. I can't do the debits and credits in my head fast enough to say, yeah, you overcounted the interest on your loans. What's that going to do to the income statement? I don't know. Let's make it right, right? Let's fix it all. And if you fix both of them, then you've got some true numbers to work with. So if one is wrong, the other's wrong too. Oh, there you go. Fix it or forget it. Because if the numbers are wrong, you don't want to be making up stories about wrong numbers, right? So uh, now you got true numbers. Now you've fixed all these things and you want to explain them. How do you explain these things? Well, I like to drive better decisions by turning the numbers into dashboards. That means words and pictures that people can take action on. So what makes a great dashboard? First of all, doing it, right? Almost nobody really does dashboards, and the people who say they do probably don't do it often and regularly enough to make it meaningful. So committing to doing a dashboard every day or week or month, really important. You got to get on that regular cycle of actually doing it. Pick 3 to 5 to 7 metrics, no more than 7. It's a golden rule that you just can't, your brain can't handle more than 7 details at a time. So you want to boil it down until you get 7 details or 7 metrics that you want to measure. And you want to have a mix of both leading metrics and trailing metrics. That means trailing is what happened last month. Leading is what happened last month. It's going to lead me to something. So a great leading index is, for example, number of visitors to your website. If you're an e-commerce company, you want to drive visitors to your website so that you can convert them into sales. So if you see that trend of visitors to your website going up, you can know, hey, next month I'm likely to have even more. I'd better stock up, put something on sale, something like that, so that we can convert more of those sales. So leading metrics and trailing metrics. and put it somewhere prominently. Now, do you see this thing on the right, the one that looks kind of wonky? It looks wonky because I drew that by hand. This was my very first dashboard ever in my life. I was 22 years old, running a tech company in Kansas City, Kansas, and I wanted to keep track of things that we thought were important to measure. So I got a big piece of newsprint, just tore it right off of one of those giant pads, right? It was 4 feet long and 2.5 feet wide, and I taped it to my door of my office, and I drew 6 metrics that I wanted to keep track of. And every day when I passed that to go into my office, I would either update it or I would sit and look at it, and it would remind me of what's important and where are we in terms of where I want to be, and historically, what is the trend. So make it easy to see, post it prominently, and keep it up to date in real time if you can. How do you pick those 3 to 7 metrics? I have something, and I made this up. You can like it or hate it. I don't care. It's called the Tiger method because it reminds me that the timing of a metric is important. You want to update your metrics regularly and show the trend line. So you can't just take one-time snapshot. You have to take it regularly and see the trend. Maybe T should have been for trend. I is you've got to pick numbers that are impactful for your business. You can't pick something that you can't control. The temperature outside for an e-commerce company, probably not important and not impactful. Now, temperature outside for Duke Energy actually determines a lot about their energy load on the network. So maybe that is impactful if you're Duke Energy, but you want to pick metrics that have a real impact on your business. G, they got to be goal driven. So you've made a vision and mission for your company. You've set a goal of selling $5 million. The numbers that you pick have to gel with that. They have to get you to your goal, right? They have to be important enough that you're going to accomplish what you want to accomplish. They got to be easy because there's power in simplicity, and they've got to show the interdependencies, the relationships between multiple things going on in your company at once, because companies are complicated. Our business is not always straightforward. This is not a lemonade stand we've got going. So let's pick something that's a little bit sophisticated that shows us the relationships. And for relationships, I love nothing better than a ratio. So that's what I mean by showing a relationship between multiple things, are ratios. And some common ratios you've heard of is assets over liabilities. Textbooks call that the quick ratio. It tells you if the world stops spinning tomorrow, whether you can pay your bills or not. We used to laugh about that because the world's never going to stop spinning. Well, how does that happen? And then, of course, COVID came and proved us all wrong. Quick ratios actually are important. I like some of these mixed financial and operational ratios, like for this company we just looked at, revenue divided by inventory value. That's called your inventory turnover. And it's measuring 2 things. So it's showing you the relationship between revenue and the value of inventory that you've kept in the back. So it tells you a lot about, are you buying stuff too quickly? Are you hanging on to it too long? Should you be discounting? Where is all your cash? And maybe you're keeping too much cash wrapped up in inventory. And then finally, there are other ratios based simply on what kind of business you're in, like the lifetime value of a customer divided by the cost to acquire that customer. If you are a SaaS business, that's software as a service, right? If you're a SaaS business, everything is online. You're paying for advertisements to get customers to come in, and then you're keeping them for a number of months while they pay you a subscription. Boy, this lifetime value divided by cost to acquire, that is your lifeblood. That is one of the most important ratios in the world. Maybe you want something simple like social media engagements divided by total posts. You could say, wow, in October, I only posted 5 times and I only got 5 social media engagements. That's just a ratio of 1. But November, I posted 10 times and I got 20 engagements. Okay, now I'm at a ratio of 2. So I'm doing something better. It's not just that I'm posting more often, it's that my posts have a higher quality. They're driving more engagement. And so you start to see those relationships, and you can intuit, or you can learn something way beyond just the plain numbers. You can learn something about what's really driving the engagement. So it's not just the number of posts, but it's the quality of posts. And you'll see that when you use a ratio. So some quick ratios there. We could go on and on about them, but let's say that you've picked 4 or 5 of those. You want to set up a dashboard. How do you do this? And if you don't have a piece of paper like I did, there's my newsprint piece of newsprint on my door again. If you don't want to do that old-fashioned way, There are some very cool tools like Sife.com, one of my favorites. Sife even allows you to put your dashboard onto a television so that the whole company can see it. Monday.com, if you're kind of a little more old-fashioned, you like this Airtable approach, you can build dashboards in Monday. There's one at the bottom right that I made in Monday, which just gives me a green, yellow, red sort of way to evaluate. You'll notice there that it says, what is my KPI, my key performance indicator? So the name of the metric, who is responsible for it, what's my target, and then GYR, green, yellow, red. Am I doing well or not so well? So those sorts of things Monday does very well. Um, Google Sheets, you don't want to pay for something, get a free Google Sheet, make your own little cross tab, make your own little green, yellow, red. And finally, don't forget my favorite, which is the paper and crayons, because man, once you get out the paper and crayons, it's right there in front of you, and you can see it every day. All right, last slide. You've been waiting for this. Big conclusion. I hope I've given you a little bit of information about how to read your financial statements, how to know whether they're correct, and which kind of red flags and warning signs to look for. So remember those red flags and warning signs the next time you're looking at your financials. Tell a story by looking at the comparative balance sheet, by looking at, we didn't do a comparative income statement, but you can certainly do that to say whether revenue is going up or down. And then finally, check that story with the management, right? Take your story back to people who are on the ground and know what's really going on and make sure you got it right. And then use a dashboard, some pictures and some stories to tell managers something that they can use to keep their business improving. And remember, my favorite thing as a financial analyst, you can only change what you can measure. Measure, 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 and then reflect back and make changes and see how the numbers change again, right? So you make it, you take an action and you see the results. And then based on the results, take another action. You can only change what you can measure. So thank you so much for joining me. I am ready to take any additional questions.
Thank you, David. Thank you for such an insightful presentation. We have a lot of great feedback, going on in the chat, and hopefully you can see those little reactions on
I
your.
do. Thank you. I like that.
Before we dive into some Q&A, just reminding everyone now is the time to get straight from the source insight from David. And also we understand if you need to run, just know again, quick reminder, today's session is being recorded and will be emailed to you within the next 48 hours. If we don't get to your question today, you can connect with David via the channels on the screen. They will be in the chat shortly as well. Okay, so with our remaining time, let's get to a few questions here. Um, the first question I want to take is from Carla. Um, can you expand a bit on what the EBITDA can say about a business, what kind of story it tells?
Excellent question, Carla. So I think of EBITDA, and QuickBooks calls it operating profit, right? It is the profit from your direct operations. Forget everything else. Forget whether you had to borrow money from your dad or from the bank. Forget about whether your customers use, whether you use a credit card, whether you're behind on your payments. It's talking about the very basics of buying and selling what you buy and sell, right? I buy time from accountants and I sell bookkeeping hours. You might buy, nuts and bolts and sell them online. So EBITDA boils all that down and just says, are you making a profit from that basic operation? It does something else also. It allows you to, if you set it up right, you'll start to see where your problems are. If you set up the COGS and the overhead expenses, you can start to see the relationship between COGS and overhead expenses. And I'm getting a little off track, but one of the ratios I should have highlighted is called the break-even ratio. If you know your total overhead expenses and you've correctly pulled all your variable expenses out and put them into COGS, and now you've got your fixed expenses to be your overhead, you can immediately know what your break-even sales level is by taking the ratio, the total amount of expenses divide by the gross margin percentage. So there's a really great ratio for you related to that. And I think, I mentioned it on your EBITDA question because to me, EBITDA just means you set up your books correctly. And that's one thing that it tells me that you've really thought about what is variable expense, what is a fixed expense, and what is an extraneous expense that doesn't have anything to do with your core business. Maybe you started a whole new business division and you want to put that under the EBITDA line so that it doesn't confuse you. Maybe you've I don't know, funded something crazy different. You're giving away big Christmas presents for your staff, and you just want to put that under the line because it's never going to happen again. Oh, here's a good one. Lawsuit losses or gains for that matter. If somebody sues you and you lose $1 million, that has nothing to do with your operations. So it would not be in your EBITDA. A loss from a lawsuit would be in an other expense below the EBITDA line. So really helps you focus on just operational profit and what do you got to do to change the basic fundamentals of your business to make sure you're making a profit.
Thank you, David. And we have time for a couple more here. Moving on to a question coming in from Melinda. Um, do the best metrics to track change for a non-inventory company? Things like inventory turnover are great for commerce or retail, but what might be the best for services?
Yeah, I've got some favorites for services, and I'll plug my friend Greg Crabtree. Write that down. Greg Crabtree wrote a fantastic book called Simple Numbers. And if you really like to read, after you get done reading my book, the Entrepreneur's Guide to Financial Statements, go out and grab Greg Crabtree's Simple Numbers 2.0. Don't get the first one. It's about that thick. It's kind of boring. The second one is really good. Simple Numbers 2.0. And Greg says in a service business or any business really, you want to measure labor efficiency. So let me put it into my world. I have a service business, right? Labor efficiency for me is the direct labor, the accountants who are doing accounting. It's the ratio of what I pay them in salary compared to how much money they can make from my customers. So it's just that simple. I pay them $75 an hour. I bill them at $175 an hour. And if I do that all month long and they take smoke breaks and vacations and holidays and all these things, it's not going to be 75 and 175. It's going to be 75 and 175 minus holidays and PTO and all that stuff. So at the end of the month, you measure your direct labor efficiency ratio, the amount of money your staff made divided by the amount of money you paid your staff, and chart that over time. And you want that to be at least 2. And in some businesses, service businesses should be much closer to 3 times. So I should make 3 times as much money as I pay my staff. I'm not going to do it at 75 and 175. I've got to either pay my people less or charge more for them. So it's a good pricing tool. The second labor efficiency ratio is management labor efficiency. And you can look at how much do you pay your managers, including yourself, if you're not really customer facing, and divide that into the gross margin. Because managers have a lot of control over giving the employees the right tools and scheduling them at the right time and all those things. So management labor efficiency should also be in the 2.5 to 4 range, right? You ought to be able to really get that number up there. And if it's too low, what it's telling you is you have too many chiefs and not enough Indians. I hope that's not XPC or something to say that, but you know what I mean? You've got too many managers and not enough staff, right? And if you're top heavy with all these managers, your management efficiency labor ratio, MLER, management labor efficiency ratio, is going to fall apart, and you'll know that you've got problems and you'll see it coming. So Greg Crabtree's book, Simple Numbers 2.0, is a really good deep dive into the 4 or 5 metrics that you can use for, especially for service businesses, but almost for any business, really.
Thank you, David. I want to squeeze in the last question here. Um, Coming in again from Melinda. Um, how do we determine and use the cost of customer, lifetime value or cost of customer acquisition?
Wow. Yeah, that's a great one. So if you are in an online business, almost any business really, you're advertising for customers, you are going to trade shows, you are traveling to a foreign city, whatever you're doing for marketing and sales, costs you something. If I invest $10,000 and go to a trade show and I get three customers, each customer costs me $3,500. I better be darn sure that those customers are going to make me a profit of greater than $3,500 at least over their lifetime. Hopefully they make it pretty quickly, right? Hopefully it's this year or next year that they're paying me back profits of more than what I've invested. But if you're a really hardcore SaaS and you're VC funded, what you need to tell them is, I pay $37 to advertise to get one customer, right? I'm buying pay-per-click ads on Google or whatever that is. I pay $37 and that customer's lifetime value is 350 bucks because they pay me $35 a month for an average of 10 months. So I'm going to pay 37, I'm going to make 350. That's a really powerful business model, but you got to know both of those numbers. You got to know what it costs you to acquire a customer and how much profit that customer is worth to you over their lifetime. And you can apply it to an accounting business or to an e-commerce business or any other really. So CAC, cost to acquire a customer, and LTV, lifetime value of a customer, very important numbers. Thank you for that question. And by the way, Tara, you probably already said this, but I am happy to answer emails. You are welcome to email me directly, David@Fuse, or let's link up on LinkedIn. I am Worrell, Worrell at LinkedIn.
Yeah, absolutely. And again, they're on screen. They are in the chat as well for you guys to easily click. And great timing because that is just about all the time we have for today. I hope you all learned half as much as I did. It definitely seems like it. If we didn't get to your question today, again, please feel free to follow up with David after this webinar. I know, again, he'll be more than happy to chat with you. Before we go, I'd just like to encourage you to participate in the quick 1-minute survey that will pop up in your browser once we close out this webinar. We take all of your feedback into consideration, so thank you in advance for that. And a big thank you to our sponsor, Bill, and a special thank you to our incredible speaker, David Worrell, for answering our questions and providing us with a great presentation today. Thank you, David.
Thanks everybody for joining.
Yes, a huge thank you to all of you for attending, spending some time with us today. Again, my name is Tara, and I hope you have a great rest of your day and a great rest of your week.